there's a strange rhythm to human progress. Every few decades, the music stops. Factories fall silent, stock markets collapse, and the confidence that once seemed unshakable vanishes overnight. We call it an economic recession, but beneath that sterile phrase lies a story of human psychology, greed, fear, and survival. Today, we will trace this pattern from its beginning to its end. This is MoneySketches, explaining the anatomy of a downfall. In simple terms, a recession occurs when an economy stops growing and begins to shrink, typically defined as 2 consecutive quarters of negative GDP growth. That's 6 months of the economy making less stuff than before. But that's just the surface. Behind every chart lies a collective mood shift. People stop spending, businesses stop hiring, banks stop lending. Confidence, the invisible fuel that keeps capitalism running, simply evaporates. This illness, this paralysis, has happened many times. The most infamous collapse began in 1929. In the Roaring '20s, America seemed unstoppable. Stock prices soared, fortunes were made overnight, and optimism became the national religion. But in October, the illusion cracked. The market crashed. Within weeks, millions lost their savings. Factories shut down, farms went bankrupt, and lines for bread stretched for miles. For nearly a decade, the world economy remained paralyzed. It wasn't just an economic collapse, it was a psychological one. Faith in the system had been shattered. The system was rebuilt, but the pattern would repeat. Fast forward to 2008. This time, the enemy wasn't drought, it was debt. Banks created complex financial products built on subprime mortgages, betting that housing prices would rise forever. They didn't. When the bubble burst, global finance seized up. Lehman Brothers collapsed. Trillions vanished in days. And once again, governments stepped in, not to rescue people, but to save the very system that had failed them. The pattern was the same: a long buildup of greed, a sudden loss of trust, and the painful realization that nothing grows forever. And just when we thought we understood financial risk, then came 2020. A virus, invisible and indifferent, brought the world to a standstill. Planes grounded, cities empty, supply chains snapped like fragile threads. This time, the cause wasn't financial speculation, it was biology. Yet the outcome was familiar: panic, job losses, and uncertainty. Governments printed trillions trying to keep economies afloat, but money alone couldn't buy back certainty. Because every recession, no matter its cause, follows the same emotional curve: euphoria, overconfidence, denial, panic, then finally, renewal. It's a cycle as old as commerce itself, what economist Joseph Schumpeter once called creative destruction. Recessions burn away inefficiency, forcing innovation. Like a forest fire, they destroy the old to make room for the new. Painful, yes, but necessary. But necessary is a cold economic word. Beyond the theories and graphs, recessions are deeply human. They mean a parent losing their job, a small business closing their doors, a student shelving their dreams. Economics may describe patterns, but it cannot quantify despair. And yet, within that despair, societies rediscover something fundamental: resilience, a quiet determination to begin again. Perhaps that is the paradox of recessions. They remind us that progress isn't linear, that wealth like confidence is fragile, and that every boom carries the seed of its own collapse. But maybe that's what keeps us human. We fall, we rebuild, and in the silence after the storm, we learn once again how to begin. Understanding this cycle of collapse and rebirth is key, but this cycle is often triggered by another economic monster, that invisible thief that eats your savings even when the economy is good. That is inflation. Click here to learn how to fight it, and subscribe to MoneySketches.